Hey everybody, it's Tony Nitti, tax partner with WithumSmith+Brown, tax writer for Forbes.com. And I just wanted to show up here for a couple minutes to just get everybody caught up where we stand today with regard to this path towards tax reform. And I don't think it's an overstatement to say we're kind of on the brink of history, right? The heavy lifting has been done. The House passed its version of the bill. Senate passed its version of the bill. And as of early this morning, we're hearing that the House and Senate representatives got together in conference over the last couple of days in committee and ironed out what they're calling a finalized tax bill. Although, if we learned nothing else over the last 31 years, it's not final until it is signed into law. And so remember, right? Like I said, the heavy lifting's done, but we're not at the finish line, because even if the House and Senate representatives have come up with a final bill, it needs to now pass a vote in the House and a vote in the Senate. And that is never as easy as it sounds, even though versions of these bills have already passed the House and the Senate. So what should we expect to see in this final bill? It's going to look a lot like what we've already seen kind of between the House and the Senate, with obviously some concessions made. And then there's kind of still a hidden mystery. All right, what am I talking about? Well, what we're seeing in this final bill is all the good news, right? A lot of additional tax cuts. So the top rate on individuals, which was 39.6 under current law, 39.6 under the House bill, 38.5 under the Senate bill, would actually come all the way down to 37%. We're also hearing that the bills are going to settle on the Senate's version of the child tax credit, which means a doubling from $1,000 to $2,000. We are hearing that the pass-through rate, right, the way we're going to treat income on S-corp owners and partners and partnerships and sole proprietorship, is going to be a bit of a hybrid between the two. We don't know exactly what that means, but it sounds like we're going to take the deduction regime of the Senate bill, which effectively just means you're going to report the income related to your S-corp or partnership, but then you're going to get to take a 20% deduction of that income with a host of caveats, right? Limitations based on W-2 wages paid out by the entity, limitations if you ply your trade in a personal service business like an accountant or a lawyer. But we're hearing that the rate will be 20%, but we're also hearing that there's going to be some elements from the House bill in the pass-through treatment. And we're not quite sure what that means at this point, because the House bill just had a flat 25% rate. And so it's pretty curious to see what elements they're going to take from the House bill and incorporate into the overall treatment of pass-through entities. We are also getting more good news in the sense that student loan interest deductions are going to be allowed. Medical expense deductions are going to be allowed. We are hearing that the controversial aspect of the House bill, where tuition waivers would become taxable if granted to a dependent of a university or college employee or to a candidate for a doctorate at a graduate school, those would have become taxable under the House bill. We're hearing that those will not be taxable. So we're getting a lot of good news. But anytime you have good news in a tax reform bill, remember, right, you can't just give the good news with impunity, because this bill, they're using what's called the budget reconciliation process, which means the total cuts can't exceed $1.5 trillion over 10 years if the Republicans hope to pass the bill without a single vote from a Democratic senator. You can't exceed $1.5 trillion in cuts over 10 years, and we just heard a whole bunch of good news. And so when you get all that good news, you have to ask, well, how are we paying for it? Because if all we do is take the good news, we're going to be well in excess of $1.5 trillion. And so there's going to have to be a bunch of revenue raisers that we're going to see in the law as well. The only ones we've really heard about so far are, number one, the corporate tax rate, instead of going to 20%, will go to 21%. But that's only going to raise about $90 billion over the next 10 years. So that's not going to get the job done. Then we're hearing that the deemed repatriation rate on foreign income will be ratcheted up a little bit, closer to 15% on cash and 8% on illiquid assets. And then we are also hearing that the estate tax will remain, albeit at a doubled exemption amount, $11 million if you're single, $22 million if you're married. So even with those amounts, being added back on the estate tax side, the corporate income tax side, and the international side. I don't think that's enough to pay for the magnitude of cuts that we already talked about. And so I think there's some surprises in store in this final bill, particularly when it comes to timing, right? Currently, the House bill, all of their individual cuts would have been permanent. Under the Senate bill, they would have all expired at the end of 2025. I have to believe we're going to see something that mirrors the Senate bill, where there's no way these individual cuts could be expected to last the full 10 years of the budget window and yet still fit within this 1.5 trillion size total tax cut box. So my expectation is all these tax cuts that are being layered on at the last minute are great, but they're going to come at the cost of complexity and uncertainty, right? We'll probably have an arbitrary expiration date at some point, whether it's 7, 8 years in the future, we'll have to see. And then finally, like I said, just understand that it's not done until it's done, right? Earlier today, we heard Senator Marco Rubio say that he is a no vote if he doesn't get some of that additional child tax credit, right? The child tax credit is going to go from $1,000 to $2,000. He wants some of that additional credit to be refundable against potentially payroll taxes. And he has now drawn a line in the sand and says he's a no vote if he doesn't get that. Well, remember, as currently constituted, Republicans own 52 seats in the Senate, and they would need at minimum 50 votes because in a 50-50 tie, Vice President Pence would cast the tie-breaking vote. So Republicans can only afford to lose 2 senators. You get to number 3, it's over. And if Rubio is truly a no, and Senator Corker already voted no when it went through the Senate the first time, that's 2 no votes, and things could get pretty dicey pretty quick. And one I would keep an eye on would be Senator Collins out of Maine, because she has said if she doesn't get the assurances she needs about health care protections, she would be a no vote. And the health care protections don't look like they're coming because, remember, the House bill would not have repealed the individual mandate. The Senate bill would repeal it. And all indications from what I'm hearing is that this final bill will, in fact, repeal it. So if the final bill is going to repeal the individual mandate and there's not going to be any other concessions made to Senator Collins, hey, we could be, really on thin ice early next week with 3 potential no votes in the Senate, which would just put an end to this particular budget reconciliation process, and it would be back to the drawing board. So we're 95% of the way towards the most comprehensive tax reform in the last 31 years, but it's the last 5%, right, that are always the hardest part to get. So we'll keep an eye on what happens, and if we do get that monumental moment, we'll come back and get everybody up to speed. I'll talk to you then.